Welcome to StockTok's deep dive into Agnico Eagle Mines. Agnico Eagle is one of the world's largest senior gold producers, operating a diversified portfolio of mines across North America, South America, and West Africa, generating revenue from gold and silver production. As of May 1st, the stock is trading at $183.56. Over the past 52 weeks, the stock has traded as high as $255 and as low as $103. The 50-day moving average sits at $211, while the 200-day moving average is at $176. This price action puts the stock about 13% below its 50-day trend, suggesting a period of recent weakness. The Relative Strength Index, a measure of momentum, is reading 34.2, indicating the stock is not yet in oversold territory but has moved away from overbought conditions. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Agnico Eagle operates a world-class portfolio of precious metals mines with a strong focus on gold and silver production. The company's competitive advantage rests on several pillars: operational excellence across geographically diversified assets, long mine life reserves, and consistent free cash flow generation that funds both dividends and growth capital expenditure. Revenue is primarily driven by gold prices and production volumes, with a cost structure that allows the company to remain profitable across a wide range of gold price scenarios. The StokTok score for Agnico Eagle is 74 out of 100, signaling a broad buy thesis. Breaking this down by dimension, Valuation scores 17 out of 20, indicating fair to attractive pricing relative to intrinsic value. Financial health scores a perfect 20 out of 20, reflecting an exceptionally strong balance sheet. Profitability scores 17 out of 20, showing consistent and substantial margin generation. Growth scores 18 out of 20, demonstrating solid expansion momentum. Smart money allocation, however, scores only 2 out of 20, suggesting institutional buyers have been modest in recent activity relative to consensus bullishness. Now, valuation. The question every investor has to answer: are you paying the right price? Agnico Eagle is trading at a price-to-earnings multiple of 17.25 times trailing 12-month earnings. Looking forward, the consensus forward P/E ratio sits at 13.37 times, which is notably lower, suggesting Wall Street anticipates near-term earnings expansion. The PEG ratio, that is, the price-to-earnings multiple divided by the expected growth rate, comes in at 0.84. Any reading below 1.0 is classically considered attractive, as it implies the market is not charging a premium for growth. In our view, this is a constructive signal. On an EBITDA basis, the enterprise value to EBITDA multiple is 9.3 times, which is reasonable for a large-cap precious metals producer. The price-to-sales ratio is 7.59 times, somewhat elevated but typical for a business with this level of profitability. Our DCF model suggests the stock is trading at a 35.88% discount to intrinsic value. In other words, the stock appears to be priced at roughly 2/3 of our calculated fair value, providing a meaningful margin of safety. Wall Street analysts, 14 of them in total, have a consensus mean price target of $253, significantly above the current trading price. High-end targets reach $333, while conservative estimates land as low as $93, reflecting the range of macro and commodity price assumptions across the street. Moving to earnings execution. In the most recent quarter, Agnico Eagle reported earnings per share of $1.94 against a consensus estimate of $1.77, delivering a beat of roughly 10%. Revenue came in at $4.1 billion. The company reported operating income of $2.56 billion and net income of $1.7 billion. Revenue expanded 15% year-over-year, indicating solid operational performance and favorable gold price realization. This beat came against a backdrop of strong operational performance across the mining portfolio and better-than-expected cost management. Looking forward, The next earnings announcement comes on July 29th, with consensus earnings per share expectations of $3.28, with estimates ranging from $2.96 to $3.92, suggesting material upside potential if current guidance holds. The economic moat here is substantial. Precious metals mining is capital-intensive with decades-long asset development cycles, creating high barriers to entry. Agnico Eagle's diversified geographic footprint, established operating track record, and access to capital all reinforce competitive positioning. From a peer perspective, large-cap gold miners typically command valuations in the 12 to 18 times forward PE range, depending on reserve life and cost structure. Agnico Eagle's current forward multiple of 13.37 times sits comfortably within this range and appears reasonable relative to historical trading patterns. Market sentiment around Agnico Eagle leans bullish. Goldman Sachs has recognized the company as a top gold stock pick. SIBC has assigned an outperformer rating. Additionally, the company recently executed a strategic $325 million acquisition of a stake in the B2 Gold Fingold joint venture, expanding the asset portfolio and signaling management confidence in the gold production outlook. The broader precious metals industry outlook remains constructive, with increased institutional analyst coverage and anticipated market growth tailwinds. That said, macro headwinds, including interest rate volatility and broader equity market sentiment, provide some counterbalance to the bullish tone. In our view, the valuation setup is attractive. The forward PE is reasonable, the PEG ratio is compelling, and the DCF margin of safety provides downside protection. This is a stock where the price is not extracting a full premium for execution quality or growth prospects. Moving to financial strength. How solid is the foundation? The Piotroski F-score, a 9-point financial health checklist developed by accounting researcher Joseph Piotroski, measures profitability, operational efficiency, leverage, and liquidity across 9 discrete tests. Agnico Eagle scores a perfect 9.0, meaning it passes every single criterion. The company is profitable, generating positive operating cash flow, maintaining stable or improving leverage, and showing no red flags in working capital or asset quality. This is a rare score and signals fortress-level financial health. The Altman Z score, a bankruptcy risk model, comes in at 7.03. A score above 2.99 indicates a safe, financially stable business with minimal bankruptcy risk. Agnico Eagle is well above that threshold, confirming structural financial safety. On the balance sheet itself, the cash-to-debt ratio stands at 8.94, an exceptional level. This means the company has nearly $9 of liquid cash for every dollar of debt obligation, a luxury few large-cap industrials enjoy. The interest coverage ratio, that is, earnings before interest and taxes divided by interest expense, reaches 185.65 times. This astronomical figure reflects the company's ability to service its debt obligations with extreme comfort. In practical terms, even if EBITDA fell 99%, the company would still cover its interest payments many times over. Current ratio, a measure of short-term liquidity, sits at 2.02, well above the 1.0 minimum threshold. This indicates the company has $2 of current assets for every dollar of current liabilities coming due within 12 months. The debt-to-equity ratio is essentially 0.01, indicating the company is nearly debt-free on an equity-adjusted basis. This capital structure is extraordinarily conservative. What does this all mean? Agnico Eagle's balance sheet is fortress-like. The company has virtually no leverage risk, exceptional liquidity, and the ability to weather severe downturns, continue paying dividends, and fund growth capital expenditure without external financing. From a credit analyst's perspective, this is a best-in-class balance sheet for the mining sector. Next up, profitability. Is this business actually making money efficiently? The return on invested capital, or return on invested capital, stands at 14.52%. This metric answers the question: for every dollar of capital the company deploys, how much incremental profit does it generate? 14.52% is a strong figure for a large-cap mining company, indicating that management is deploying capital productively. We'd want to see return on invested capital above 10% to justify further capital reinvestment, and Agnico Eagle clears this bar comfortably. Gross margin, revenue minus the direct cost of goods sold, divided by revenue, is 58.08%. This is exceptional. It reflects the company's pricing power in gold and silver markets, combined with efficient ore extraction and processing. Operating margin, which is earnings before interest and taxes divided by revenue, comes in at 52.91%. This is remarkable. More than half of every dollar of revenue flows through to operating profit before interest and taxes. Net profit margin, the bottom line after all expenses, is 37.43%. For context, S&P 500 companies average somewhere around 9 to 10% net margin. Agnico Eagle's 37.43% represents truly elite profitability. Free cash flow margin, operating cash flow minus capital expenditure, divided by revenue, is 33.39%. This means the company is converting about 1/3 of every sales dollar into cash available for dividends and debt repayment. In the most recent quarter, these margins remained robust, reflecting both strong gold prices and operational discipline. The company's cost structure is such that it remains profitable across a wide range of gold price scenarios, a significant structural advantage. In our view, the profitability profile is genuinely exceptional. This is not a company that is barely profitable or margin compressed. This is a business that generates substantial free cash from its operations quarter after quarter. On to growth. Is this business expanding, and at what rate? Looking at the past 3 years, revenue has grown at a compound rate of 28.2% annually. This is meaningful expansion, driven by a combination of higher gold prices, improved production volumes, and strategic mine acquisitions. Over the past 5 years, the revenue growth rate is 18.7%, slightly more moderate, reflecting the compounding effect of a longer time window but still well above GDP growth rates. Book value, the accounting value of shareholder equity per share, has grown at 12.2% over 3 years. This indicates that management is retaining earnings and reinvesting them productively, expanding the equity base and the company's ability to generate future profits. The dividend yield currently stands at 0.90%, which is modest but not negligible. The company prioritizes capital returns through share buybacks and reinvestment, with dividends playing a supporting role. In the most recent quarter, revenue expanded 15% year-over-year, continuing the growth momentum demonstrated over the trailing 5-year period. This is not a mature, stagnant business. This is a company in active expansion mode. Management has indicated confidence in future production growth through the $325 million Fingold acquisition and continued optimization of the existing mine portfolio. Looking at the forward earnings estimate of $3.28 per share, the implied earnings growth from current run rate levels is substantial, suggesting management's internal guidance supports continued expansion. One note of caution: growth in a cyclical business like mining is inherently tied to commodity prices. Gold prices are not permanently stable, and extended downturns in precious metals markets could compress revenue and earnings growth. However, the company's balance sheet strength and cost structure position it well to navigate commodity cycles. In our view, the growth profile is solid for a large-cap precious metals company, with near-term catalysts from the recent acquisition and ongoing operational optimization. Now let's talk smart money. What institutional capital is actually doing with this name? 9 top-tier investment gurus and long-term value investors currently hold Agnico Eagle in their portfolios, according to Dataroma tracking. The most notable position is held by First Eagle Investment Management, which maintains a position representing 1.55% of their overall portfolio. However, First Eagle has signaled a reduction in their position, trimming their stake by 1.26% in recent activity, suggesting some profit-taking or reallocation. Looking at broader institutional activity, through 13F filings, the quarterly mandatory disclosures of institutional investor positions. 5.6% of institutional filers are net buyers, meaning they hold positions greater than 50% cash equivalent, or are actively adding to holdings. This is a relatively modest figure in absolute terms, indicating that institutions, as a group, are not aggressively accumulating. This stands in contrast to the bullish sentiment from sell-side Wall Street analysts and the strong fundamental metrics. Insider ownership stands at 0.00%, which is notably low. This means management and company insiders own virtually no shares of the company directly. Insider transactions over the past 3 months show 0 buys and 0 sells, indicating no material trading activity from corporate officers or directors. Low insider ownership can be a minor yellow flag, as it suggests management does not have material personal capital at stake in the stock price. That said, this is not uncommon in large, publicly traded mining companies with professional management teams, and should not be weighted as heavily as insider buying or selling activity would be. The disconnect between bullish fundamental metrics, strong analyst consensus, and modest institutional buying activity is worth noting. One interpretation is that large capital allocators have already positioned themselves and are satisfied with current exposure. Another interpretation is that macro uncertainties or commodity cycle concerns are holding back aggressive institutional buying despite the attractive fundamental setup. What we can observe is that smart money is neither aggressively accumulating nor distributing holdings, suggesting a hold-and-watch posture rather than a conviction buy or sell. And finally, the verdict. Let's bring it all together. On valuation, the forward price-to-earnings multiple of 13.37 times is reasonable. The PEG ratio of 0.84 signals the market is not charging excessive growth premium, and a 35.88% DCF margin of safety provides meaningful downside protection. In our view, valuation is attractive relative to intrinsic value. On financial strength, a perfect Piotroski score, an Altman Z score well into safe territory, a cash-to-debt ratio of 8.94, and minimal leverage position the company as one of the strongest balance sheets in the mining sector with virtually no financial risk. On profitability, with a net margin of 37.43%, and return on invested capital of 14.52%, and free cash flow margins exceeding 30%, the company demonstrates elite operational efficiency and cash generation. On growth, revenue expanding at 28% over 3 years, with the recent quarter showing 15% year-over-year growth, positions Agnico Eagle as an expanding business, not a mature slow grower. On smart money, while 9 top-tier investors hold positions, broad institutional activity is modest at 5.6% of filers actively buying, and insider ownership is negligible, suggesting positioned rather than aggressively accumulating. The most recent quarter delivered an earnings per share beat, $1.94 versus $1.77 estimate, with strong revenue growth and operational execution, reinforcing the structural quality thesis and validating current guidance. Brought together, the data suggests this is a high-quality business trading at a reasonable valuation with fortress balance sheet strength, elite profitability, and solid growth momentum. The primary risk is macro, commodity price volatility, interest rate sensitivity, and broader equity market sentiment can all pressure precious metals names regardless of fundamental quality. The bear case rests on the notion that gold prices are cyclical and possibly near peaks, which could compress margins and growth rates. However, Agnico Eagle's balance sheet and cost structure position it well to navigate commodity cycles better than peers. In our view, the setup looks interesting for investors with a moderate to long-term horizon who can tolerate mining sector volatility. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Agnico Eagle Mines. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.